Dividend warnings that you need to pay attention to, as we're going to talk about here today at the Heritage Wealth Planning YouTube channel. I get tons and tons and tons of people talk about dividends, and I talk about it probably more than a lot of things because I actually think dividends are wonderful. Reinvesting dividends is absolutely tried and true behavior for successful investors for sure. Some folks like my man Meb Faber will discount the value of dividends. And I love Meb, and I'm not challenging that at all. I actually think he's onto something in that regard for sure. But historically, dividends that are reinvested have been incredibly valuable to a successful investment program for sure. But the problem I have is now that we have the internet and obviously the ease of trading, research stocks, whatnot, I do worry that some people are just buying dividends for the yield, the fat yield, and nothing else. And so I want to share with you some thoughts on what you need to be watching as you're looking at dividends and the warnings therein, because it can be pretty important. So let's dive right into this. Don't forget to subscribe down below. And as always, thumbs up, comments. I came across this guy. I actually like his channel, Let's Talk Money by Joe Hogue. And he's got his bow tie there, so you know he's smart. But actually, I like his channel, and I'm going to link to this video in the show notes. Actually, I'm a lot of stuff. I'm fond of what he does. He's got a Marine Corps thing back there. I don't know if that means he was, maybe he was in the Marines. But anyway, whatever. I like it. I like what he's talking about here. So this is a good video to start with. He does talk about AT&T at the end, some of the risks of AT&T, and he's a CFA and a chartered financial analyst. What I always tell people is, look, if you're hiring a financial analyst or a financial, an investment guy, you want to get a CFA. I mean, I frankly don't think you should, but I mean, in terms of just go to Vanguard. And Joe talks about that actually, without question. But if you're going to hire a guy to run your money, you want to make sure he's a CFA because he knows how to read the statements, the company's finances. A CFP is not an investment guy. A CFP is a financial planner. And if a financial planner is messing around and doing investment research, that is not a financial planner. That's an investment guy. Now, there are CFPs who are also CFAs, very few. I got a couple of friends like that. And the question is, which are you going to be? Are you going to be a financial planner or an investment guy? Because they don't cross. They can. It's a jack of all trades, master of none. And when it comes to your specific retirement needs, you want a master of something. And if they're going to be a master of investment research, that inherently means they cannot be a master of financial planning. They're two mutually exclusive things. So actually, I like what Joe says here. Nothing destroys value like a dividend cut. I 100% agree. I'm going to show you 3 warning signs in dividend investing so you can get out of an investment before the dividend yield is cut. I've also found one dividend stock that is flashing red all over. Now, this is back in October, and he talks about AT&T. I literally have no clue what AT&T has done since then. But the number one thing when it comes to dividend investing is what's called the payout ratio. The payout ratio. And that simply means if a company nets $100,000 of cash and they have $100,000 of dividends that they're paying out, their payout ratio is 100%. So $100,000 of net income, because remember, they got to pay tax on that income. All right. And they take that $100,000 of net income and they're spending $100,000 to you as a dividend holder, the shareholder on dividends. That's where the double taxation of dividends comes in, by the way, because they have to pay tax on the net income. They send the dividend to you and you have to pay tax on the dividend that you receive. So it's dividends of double taxation. So anyway, so that is 100% payout ratio. All their positive cash flow is going to pay out the dividends. So the question that comes in is if they have a drop in their net proceeds in terms of net cash flow, where does the money come from to pay that dividend? All right. If they have a dividend payout of $10 per share and their net cash flow is $10 per share and their net cash flow drops to $9 per share, how do they make up the difference to have a $10 per share dividend payout? Where does it come from? Well, it's going to come from debt. It's going to come from cash reserves, or they're going to have to cut it. One of those 3 things. There's just no other way around that. And that's a problem because if it comes from debt, it's almost, again, it's like you're refinancing your credit card with other credit cards. At some point, you got to pay the principal. So if it comes from debt, you can't do that forever. That simply will not happen. If it comes from cash flow and it's just a one-off thing, whatever, there's a one-time charge, they had a bad year, something like that, That's different. That's different because they're just reducing their cash availability under the hope that the payments or the net cash flow will increase in the future. That doesn't concern me all that much. The debt increasing does concern me, frankly. So that would be a big one. So remember, the number one risk to a dividend payment is payout ratio. So I went to look at this. I searched some companies that are having high dividend payouts. This is from dividendinvestor.com. I don't know much about their website. I just don't care. But this is back. I think they did this article in September. And they talk about 5 companies that have a high dividend payout. Here's Kimberly-Clark at 81%. Here's Reuters at 83%, IBM at 98%, Pepsi at 108%, and Coke at 271%. Wow. So that's interesting to me. And again, this is back in September. I didn't even look. I just looked at Kimberly-Clark and I stopped there. So let me just, why is Pepsi and Coke? Coca-Cola manufacturers, distributors, we know all that. Despite the extremely high payout ratio, the company has maintained its record of boosting annual dividend payouts for the past 56 consecutive years. The company's most recent boost was a 5.4% hike in the first quarter of 2018. This increase brought the annualized dividend amount to 1.56, which is a currently yield of 3.4. The yield is nearly 10% above the company average of 3.1 for the past 5 years. Most importantly, that yield increase was not driven by declining share price. While declining with the overall market pullback in February, the share price recovered fully back in September. I literally have no clue what it's doing now. Coke continues to perform well in terms of dividend distributions and asset appreciation. However, a dividend payout ratio at this level is a legitimate concern. I 100% agree. Current shareholders and interested investors must monitor the direction of the payout and act accordingly. A high payout ratio is generally a warning sign that a company will have to cut or eliminate the dividend distributions altogether. However, consider that high payout ratio is the only negative indicator among positive signs that others will present the security in the favorable light. I don't know how you keep funding a 271% dividend payout rate. I don't understand that at all. That is weird to me. We might have to dive into that. How do you have a 271%? Remember, all net cash is going to dividends plus another 171%. I mean, so either they're taking a mass amount of debt or they have mass amount of cash. Or a combination of those three. That's nuts. All right. But anyway, let's go to Kimberly-Clark. So that's one I looked at. So I want to start here. And this is Kimberly-Clark, KMB. And this was interesting to me. Now, this is as of yesterday's close is $115 per share. All right. So the first thing we want to do is, and I'm not going to get into PE ratios or anything, or just the ratios, price to book, price to earnings and all that. It's just right now, that's not what I want to show. I want to show, where's the dividends? Right here. All right. So the payout ratio is 86.49%. The 5-year right now, the forward annual dividend yield is 3.5. I don't know how you figure that out. I mean, I know, but I don't get that. All right. So they have a payout ratio of 86.49%. All right. So the question I want to see here is they have how much cash? They got $494 million of cash, and they have cash per share, $1.43 per share cash. All right. So they have we'll just say for round up, we'll say $1.50 cash per share. And yet they have total debt of $7.6 billion, of which their total debt to equity is 6,773%. Negative current ratio. How do you, so they don't have enough cash. Let's just put it that way. The total cash per share of $1.43. All right. And they have, $8 billion of debt and a total debt to equity of 6,000%. That's so, and now their dividend payout, let's take a look here. Does it say here what their dividend, let's just go to summary. So what does it say what their dividend, the actual dividend, remember they got $1.50 per share cash, and their dividend is $4. So they have a $4 dividend and only $1.43 in cash. Where does that money come from? And they already have a high payout rate. I mean, I just sit there and think you got a high payout rate of 87% already, which means basically 87. If you have $100 of net cash flow, 87 of that is already attributed to the dividends. You only have $1.43 of cash on the side in which you can draw in to make up the difference between those dividends that you don't have in terms of net cash flow. And you already have a pretty significant debt to asset ratio, and you have billions of dollars in debt. Where does the money come from? I mean, I just don't know. This is what I'm talking about. I have no clue. Where does it come from? So let's look at some historical statistics. I mean, I don't get it. I don't get where that money comes. Well, I want to go to, now I just want to go to financials. Bear with me just a second. So, does that mean it's going to cut the dividend? I have no idea. But where does that money come from? Look at return on equity, 540%. My inclination, I bet they took on heavy debt. So let's take a look. Why do they have such a high return on equity? Probably because they took on significant debt. I don't know that. I've yet to look at this other than what I'm showing you here. I'm drinking my Walmart coffee, by the way. Walmart dark roast is good. All right, so gross profit, $6.5 million. All right, so operating expenses is $15 million. All right, so operating income, they have $3 billion of operating income. Net income from continuing operations is $2 billion, and we just talked about how much cash they have on the side. So but I actually want to show you something. Watch this. You ready? I want to show you what let's go to their cash flow. Cash flow right there. All right. So they got $2 billion of operating income. So let's take a look at how much of that is going to the dividend, shall we? And we look at did it give me cash flow? Ooh, there we go. Give me their Yahoo or what? All right. Let's try this again. Well, there we go. All right, so cash flow. So their dividend is $1.3 billion of dividends that they paid in 2017. $1.3 billion of dividends. And again, we go to their income statement. Their operating income, there we go, is $2.3 billion of operating income. All right. So what does that mean? There you go. I mean, they're paying a significant amount of their operating income out to dividends. Part two is how much cash they have. Well, if we go to the balance sheet, we will see that they have the equivalent of $1. And this again, as of the end of 2017. We're now in the first month of 2019. I have no clue what has changed. But if we look at their balance sheet, which I thought we were clicking on, we'll see they have the equivalent of $1 per share of cash. So again, why is it not? There we go. Oh, there we go. Cash. So let's just look at simple cash and look at that goodwill. 1.57 of their total assets is in goodwill. I just don't get that. All right. So anyway, $616 million. So we already showed you. They get, what did I say, like $2 billion of operating cash flow. 1.3 is already attributed to the dividend, and they only have $616 million of cash. Where are they going to get the money for the rest? I just don't know. The current liabilities, they have $15 billion of total assets, of which half of that is just in their buildings. And then what's that? 10% is just in goodwill. I mean, you can't convert goodwill to cash to pay the dividends. Current asset, look at that, net receivables, 2.35. Hopefully they can turn some of that to cash. The thing about high net receivables is that a lot of times you're not converting 100% of those to cash. You're just not. Inventory 1.7. I mean, in of itself, that doesn't mean anything. But the cash is what concerns me right there. And the cash has dropped from 789 to 619 to 923 to 616. So the last 4 years has dropped by $150 million, $170 million. Well, I have a sneaky suspicion that's because they're paying the dividends from that cash. All right, so let's just look at liabilities. Well, long-term debt has gone up from $5.7 billion to $6.5 billion. Short-term debt hasn't done much. That's good. Accounts payable has stayed about the same, about $2.5 to $3 billion. The total current liability is actually down a little bit. So, I mean, the way they've been paying their dividend looks to me, at least in the last year, is simply by taking out the cash flow, and their cash has dwindled quite a bit. So here from 2016 to 2017, the cash flow is down by 33%. I assure you that's because they're using that money to pay the dividend. Again, I don't know what to make of this. At least they haven't gone increasing in their debt. I mean, the total liabilities, $14.5 billion back in 2013 and $14.26 billion in 2017. So they actually done a little bit to decrease their liabilities, which is good. Current liabilities are still sitting about $6 billion though. And their long-term debt has gone up a little bit, but it looks like they've used some of that long-term debt from 5.7 to 6.5 billion to pay down some of their current liabilities, because their short-term debt is at 549 million and now it's only 406. So, I mean, that's a big deal. And I want to look at Coke here too, real quick. That shocks me. 200 and that Walmart dark roast. Whoo, it's good. All right. I mean, how does Walmart have, Coke, 270% of its net cash flows? I mean, it's got to have huge debt. I can't fathom that. So let's look at the summary. So they pay $1.56, okay, in dividends. That's it. So $1.56 is their dividend, the actual dollar amount they pay per share in dividend. All right, so let's see the statistics. Where's the PE ratio? Right there. Ooh, 72 for PE. Eesh. All right, so let's look at statistics. I got cut right there. I cut myself. I don't know what I was doing. I think I was picking up a ball my kid and I were playing and went in the prickers. Yeah. All right, so look at this trailing PE 72, projected PE's 21. How is that going to happen? Are they going to increase their earnings by 300%? I don't get that at all. I don't get how their trailing PE is going from 72 and their projected PE is 21. Where does that come from? I mean, the only way to drop your price to earnings ratio is to increase your earnings or drop your price. There's no other way. So they're going to increase their earnings by a factor of basically four times, 400%. I don't see that happening. Or they're going to drop their price by a factor of, 75%. Well, I hope I don't see that happen. All right. So let's look, what we say, $1.50 or something like that for their dividends. All right. So how much, let's see what we're looking at. I want to see their, total cash. They got a lot of debt, that's good. I mean, they do have a lot of cash, 18.85 billion. But their total debt is 2.5 times that. Current ratio, we want to see a current ratio above 1, so that's good. That's just basically current assets divided by current liabilities. Book value per share is pretty low. So let's just take a look here. So I mean, they have a lot of cash, which is good. They have a way to pay off that the dividend should they need. Let's go to financials though, because the only way they got that cash by taking on debt. I mean, if you're running all your cash flow is being used to finance your dividends, you're not paying down debt. You're just not. And the only way they have that kind of cash is by taking on big debt. There's no other way they generate unless they've sitting on a ton of cash for a long, long, long time, which at some point with their payout ratio being so high would deplete that, or this is just a one-time deal. I don't know. So anyway, let's take a look. 2017, their operating income was $9.6 billion. Let's take a look what their cash flow was in 2017. Their total dividends that they paid out was, where is it here? Dividends paid $6.3 billion. And that's in 2017. Now, again, this article we read was from 2018, the latter part of 2018. So I don't know if things have structurally changed, but they paid out $6.3 billion in dividends, and they had operating cash flow, a positive cash flow. What do we say? $9 billion? Is that what we said? $7 billion. So that's not 200%. So I don't get that. I don't get where they're getting the 200%. That's operating income 9.6. Yeah, that's not 200%. It's like 65%. I don't get where the oh, well, this is after, okay, maybe they're using I guess they're probably using it. I don't know, even that. I mean, before tax income. Now, well, I guess you got to say after taxes, because dividends are, the income they make on operating income is taxable as income. And when you factor in your interest expense, total income, earnings before taxes, 9.6, income before tax, then you got, interest, income tax. There you go. So maybe that's it. So in 2017, they took it on the chin. Okay, so I guess that's where they're coming from, because after you factor taxes, because they do have to write off interest expenses, but you don't get to write off your dividend expenses. So they had a big other income expenses net. So they got some big write-offs here. I don't know what that is. I mean, literally just don't care. But net income from continuing ops is 1.18 billion, excuse me. And yet their dividend payout is $6 billion. Again, where does that money come from? I don't know. So net income from continuing operations in 2016 was $6 billion. And let's go back to what their dividend was there. Let's take a look. What was their dividend back there? All right. And their dividend that back in 2016 was $6 billion. Yeah, I don't get it. So they're paying over 100% for sure. I don't know if 2017 was an anomaly. I just don't know. Pretty significant amounts of their net cash flow towards dividends, if not the entirety of it. That would bother me. There's no other way around that. So let's do a balance sheet on this. Now, this is why I think if you're buying a dividend-oriented stocks, you really should hire a professional, Wellington or something like that, just because, look, analysts will say this means something, and analysts have been more wrong than right. And economists, for instance, they've successfully predicted 17 of the last 4 recessions. That means they're always predicting recessions, and only 4 have actually come to fruition. Same thing when it comes to analyzing stocks, and we just don't know. We just don't know. But I would turn this over to a group like Wellington or Wellesley or the Wellington Management Firm or something like that, just to say, hey, look, I don't know how these dividends are going to run. You don't know how these dividends are going to run. But in the conglomeration, at least I'm paying somebody to look and see if there's things on the horizon that scare them, that they can get out of position, because I'm not going to do it. Me as an individual shareholder, I'm looking at Coke for the first time in probably 15 years. All right. So this is just a snapshot of what it was in 2017. I got no clue if this is, I literally have no idea. And I just don't care, because I don't get involved in individual stocks. If you are getting involved in individual stocks and you enjoy it, well, you'd be wanting to look at their balance sheets, their cash flow, their quarterlies and whatnot. But what I see here is scared the hell out of me. I'd be like, I don't know. All right, so let's look at long-term. Let's just look at their debts they have. Look at all those liabilities, $68 billion. Current liabilities are $27 billion. And that's from long accounts payable right here. Hold on a sec. Wait there. Cash, $6 billion. Short-term investments, $14 billion. Presumably that's short-term bonds and CDs. I just don't know. Current long-term debt. What does that mean? All right, but current liabilities are $27 billion. Well, where's that? It doesn't really tell us what that liability is. Accounts payable is a liability, long. I don't know what short current long-term debt means, but current liabilities are $27 billion, where their current assets are $36 billion. But a good amount of that's $20 billion in cash and short-term investments. That's good. So, I'm just telling you right there, at the end of the day, they're not making enough money to pay off that dividend. They're either dipping into cash, which they have a bunch. Don't get me wrong. They do have a bunch of cash. I mean, let's shortchange that. They got $6 billion of cash, but how much does it cost for the dividend? It's $6 billion. So if they don't increase their cash holdings or increase their profitability, that's going to be gone in a year's time, or probably not a year. Well, it could be if they have another year like that in 2017, but they really have a couple years of dipping in that cash before that's gone, and they're going to have to take on more debt. And that would be a concern to me for sure, because if they take on more debt at some point, it's like I said, refinancing a mortgage where you're paying off your current bills and you go again and refinance it 5 years now to continue paying off your bills, but you're not paying anything down. I mean, at some point, a bank is going to want to loan you money. In this case, at some point, bondholders aren't going to want to loan you money, and that'd be a concern of mine. So at the end of the day, Watch the payout ratio. I don't even know what Apple stock is. APPL. I'm just curious. Apple's a good company that's with tons of cash. Let me just show you what if you want to, look, I'm not saying you should buy. I don't get involved in individual stocks, but let's just take a look at Apple with all the cash they have on the side. Look at that. $26 billion of cash, $40 billion of short-term investments. And this is concerning, $49 billion of receivables. So that would concern me. I mean, that's a huge receivable amount. It jumped from $30 billion in 2015 to $50 billion essentially in 2000. They got it 2018. All right, cool. But anyway, they got tons and tons and tons and tons of cash, $170 billion of long-term property. And then their short-term debt is only $8 billion. I mean, look at that. They could pay off all their short-term debt by stroking a check and still have $18 billion on the side. Long-term debt is $93 billion. And they got more than enough in current assets, just current assets, which is short-term debt investments, cash. And again, the receivables, I would dispute you if you want to use that to pay off long-term debt because these have not matriculated cash. But either way, they got enough almost in just short-term cash and investments to pay off all their debt, which is sweet. So now we go to what their dividend expenditures are. The point about this is if Apple wanted to raise their share price real quickly for whatever reason, they could easily raise their dividends easily. 2 seconds flat. Their dividends that they paid $13 billion in dividends. That's a lot more than I would have thought, actually. $13 billion of dividends. And again, their balance sheet of that $13 billion of dividends, how much do they have in cash? Like 26 billion. So they got 2 years. Yeah, 26 billion. Just alone right there, they got 2 years of just their cash that they could use to pay their dividends just there alone without even tapping into receivables or short-term investments. Let's just look at their income statement and see if they're profitable. So remember, what did we say? How much did I say their dividends? I can't remember. They're paying like 20 billion. It's 2 years. 13 billion, I think, is what their total dividends were. And so let's take a look at their operating expenses. Net from continuing operations, 59 billion. I mean, so they have their payout ratio in that regard it's less than 25%. I mean, because look, they got 60 billion in net operating revenue, and they're only paying something like 13 billion or something like that in dividends. I mean, just we can look at statistics. I mean, I'm not saying you should buy the stock. I got no clue, but I like seeing stocks with lots of cash on the side without significant amount of debt, or if the debt they have significantly, they can certainly stroke a check to pay it off. Let's see what their payout rate is, probably 25% or something like that. Where's the payout rate? Did I miss it? Where is it here? Yeah, payout. Yeah, 22.84%. Anyway, that's nuts. I'm just curious what the PE ratio is. PE rate. Yeah, look at that. Man, PE ratio of 13. That's a trailing 12 months, and the forward is 12. Anyway, I'll let that speak for itself. I mean, you got a PE ratio. The trailing 12 months, which means what it actually did, is 12.99 over the last 12 months' time. The earning per share is basically $12 per share. And they have a dividend yield of 1.87 with all that cash on the side with a payout ratio of 22%. I'll let that speak for itself. That's nuts. Anyway, hope you find this helpful. Again, I'll put my link to my man's, what's the guy's name? The bow tie guy, Joe Hogue or something like that. I'll put a link to this article in the show notes. If you have questions, thoughts, concerns, share them down below. Don't forget to comment, thumbs up, and subscribe. And we'll see you guys next time on the Heritage Wealth Planning YouTube channel. Thanks, guys.